Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good weekend all. Ira Epstein of Linn Associates with your agriculture update. And this is the weekend edition for February 8th, 2019. Now remember, on the weekend edition, we don't look at the daily charts. We're going to look at the bigger picture on one monthly chart, and then we're going to move all the way to the weekly charts, and that'll be for the grains and the livestock as well. The event of the day in the ag market was the USDA Supply Demand Report, WASDE it's also called. And as I step here, and I will leave this up, I'm not going to read all these numbers and go through it with you. You can stop this recording at any point and read it yourself as you're seeing them, and they're right through here too. To make a long story short, the report did not have a big impact on the markets at all. In fact, the markets closed very close to unchanged across the board, and there weren't those wild swings after the report came out. So I'll let it go at that. If you get our agriculture written technical and fundamental information, it's really covered there in detail for you. So let's take a look at the charts and get a feel for what they're doing. On the monthly area chart of closes, you've still moved up from 833, and here you are at 914.5. And after the report, in fact, this whole week, what are you down? 3/4 of a cent? So the market is still in the area of climbing towards the resistance of 939.25. As we step here, and what this chart is this is a weekly chart from the high of 1071 to 810.5, and you can see how that all happened. And what you've done is you're in the 1/3 retracement area. This box represents a 38% retracement. Up to here is 50%, and this would be 62%. This is typically where a market starts to falter, coming from a high to a low and getting a bounce. Doesn't mean you can't go higher, but that is why you're stalling out. Fibonacci traders are probably looking at that. When we take a look at a weekly chart with my swing line study, the one thing that I see is I've still got the pattern of higher lows and certainly higher highs. For a moment there, we had stalled with a lower high, but then we came up 2 weeks ago and we've been doing fine ever since then. To break this pattern, you'd have to get under $9.75. Where's the resistance? Well, the resistance is one of the numbers at least, 943.75, the 100-week moving average of closes in terms of resistance. Support back at 892. The problem with the 892 is that it's under, well, let's take a look at this number. It might not be. That's 890.75. No, that's fine. You could still fall there and not take out a previous break low. That would be friendly to the market. Where's the resistance? It's actually much closer than the 100-day. It's the upper Bollinger Band, and you got up there last week. You flirted with that area, and you've pulled back a little bit. And at the same time, momentum is waffling. It is still in the up scale, as I call it. You haven't seen the red line completely turn down. It's still over the blue, as you can see. So they're called a K and D line technically, but whatever the reason it is one is over the other. That keeps the market in pretty good shape overall. In the meal market, you are caught in this very, very narrow range. You can almost see this clearly here. You are in a downtrend. You have lower highs. You have lower lows. You closed under the 18-week average, and momentum is pointing down. So the bears have control of this market, but the key to that is to break through this low to get the market to go down to another level. We've seen the attempts at the upside and they have failed, but this is the first time in a very long time that the market has lined up into the bear camp. In the soy oil market, the market has had a run to the upside. It is riding against the, if we look at it, the Bollinger Band top. Now that Bollinger Band top is at 30.41. We closed over it this week at 30.87. Last week, the market closed over it as well. So you've got two there in a row. And the week before, the market closed right over it. That's 3 weeks in a row. Each week, in fact, each close over a Bollinger Band when they're in sequence, I count as one of the percentage points of the theory of Bollinger Bands that 95% of the market will trade within it, which means 5% of the time it won't. It gives a 2% chance to me of next week the market being over that number. That's not bearish. It just gives an idea that you're getting a bit onto the rich side of the market, and you certainly have resistance between here, this 30.41 and 31.20 area. Other than that, all systems are still bullish. In the corn market, you had an outside week to the downside. So you have a week that took out a previous week's high and low, closed lower on the week. The market also closed above the 18-week average. So I call that neutral. While the swing line is down, the bias is up. Battleground is likely to be between. If the market continues to try to probe the downside, this 18-week average and the 100-week average. Momentum, which often leads price, is pointing down. In the wheat market, you are caught in these Bollinger Bands. You've tried twice to get through them and you haven't been able to do it. Feed as used as wheat has been down a little bit. So we got to be a little careful there, but the overall pattern is still higher lows. Do you see that? Certainly a higher high. The market finished over the 18-week average. What would negate the uptrend on the weekly chart is taking out 5, 10, and 3/4. Barring that, the bulls have control there. Momentum, though, is starting to go, I want to turn down on you a little bit. That can change very quickly, but right now it's giving a little bent towards it. In the cocoa market, you've got the seasonals turning down at this time of year. On the weekly charts, you've got lower highs, lower lows, a settlement that's under the red 18-week moving average of closes at 22.31, first support 21.73. If that lets go, then the next area could be the 20.60 to 20.80 zone, wherever that lower Bollinger Band shows up this week. Even if the bulls were able to get back over 23.04, push the market there, it would not start an uptrend because you can't get away from the pattern then of a lower low and a higher high. At this point, everything's lined up for the bears. In the sugar market, I'm watching something that's unusual taking place, but it's only unusual before a trend gets going. If you look back here, you'll see how narrow Bollinger Bands got. They tried the upside, then they didn't go anywhere, and the market moved away. We're starting to get that narrowness in the Bollinger Bands again. At this moment, you have a pattern of higher lows, lower highs. Do you see that? You're not trending. To get a downtrend going, you've got to take out 12.37. If you do that, then you're going to have a cleaner picture with lower highs, lower lows under the 18-week moving average of closes. Now, you've got a bit of divergence because momentum's trying to turn up on the market, so we'll see if it can do anything from there. In the coffee market, a lot of time has been spent trying to get up to this 18-week average of closes, and you're not going anywhere. We keep watching weather in parts of South America to see if it's going to impact the coffee. That's what's given it this little bounce. Should the market take out 101.55, what would happen is you'd have lower highs, lower lows. Momentum would likely start pointing lower. Watch out below. You could crack the 100 level if the bears could grab control. Let me come back to that. What about for the bull side? Well, since you've already got the higher lows, higher highs, don't take out 101.55 and close over 107.51, and the bulls will say, I've got this consolidation, and maybe I can get prices up there. You're at a very interesting part here. In the cotton market, the trend is still down, even after today's USDA report. Lower highs, lower lows, you've got bias down as you're under the 18-week average, and momentum is just sort of laying flat, but still a bearish chart. In the cattle market, you still have the higher lows, the higher high. Momentum is still locked in on the upside, still pointing bullish. Lean hogs are bearish. Lower highs, lower lows. And these poor hogs, they're not getting any help from the U.S.-China not getting long and doing a number of things together. So we take a look at all this. We try to figure out, and if I can get to where I want, there I am with it. We're going to write this weekend, you're going to get a tremendous amount of data, especially on the USDA reports that came out today. We cover not only all these categories, but as you see, right now weather is going to be very important. Right now the seedings are going to be important. What are the surveys going to start showing? We cover all that for the grains, the meat markets, the soft commodities. It's right there. And it comes even through the weekend into your mailbox. I'm talking obviously your email. So if you haven't tried our research, why not see what a commodity firm writes for its commodity traders? A lot different than you've probably seen before. How do you get it? You can either call my staff. You can click right up here if you'd like. That's going to take you to the front page of our website. Sign up for the different items you'd want there. Or if you're watching me on YouTube, click here. It'll take you where you need to go. I'm Ira Epstein. You have yourselves a great day, and I'll see you all come Monday.